There is a financial move that feels so obviously smart that millions of Americans make it every year without questioning it for even a moment. Pay off your mortgage early. Get rid of the debt. Own your home free and clear. Sleep better at night. It sounds like the responsible thing to do. It sounds like what your grandparents would tell you. And for most of American financial culture, it has been treated as an unquestionable good, the goal every homeowner should be racing toward. But here is what most people do not know. For a large percentage of homeowners, aggressively paying off a mortgage early is one of the most expensive financial decisions they will ever make. Not because debt is good, but because of what they are giving up to eliminate it. In this video, I'm going to show you the actual math behind this decision, the specific situations where paying off early makes sense, and the situations where it genuinely costs you, and the framework that most financially sophisticated people use when they think about mortgage debt. Because this is a decision worth understanding completely before you make it. The numbers involved are significant, and the mistake, once made, is very difficult to reverse.
Why it feels so right. Before we get into the math, let me acknowledge something. The desire to pay off your mortgage early is not irrational. It comes from a very real and very human place. Debt feels like a burden. A mortgage is the largest debt most people will ever carry. Eliminating it feels like freedom. And there is a genuine psychological benefit to owning your home outright. The security, the certainty, the absence of that monthly obligation. These feelings are real and they matter. I am not dismissing them. But feelings and mathematics sometimes point in different directions. And in the case of a mortgage, they often do. The question is not whether paying off your mortgage feels good. It does. The question is whether it is the financially optimal decision given your specific situation. That answer depends on variables that most people have never examined.
The core math, where the trap lives. Here is the fundamental calculation that drives this entire question, and once you see it clearly, you will understand exactly what is at stake. Every dollar you send to your mortgage servicer as an extra payment is a dollar that is no longer available to do anything else. It is a dollar deployed. And the question is, where does that dollar produce the highest return? When you make an extra mortgage payment, that dollar produces a guaranteed return equal to your mortgage interest rate. If your mortgage rate is 6%, every extra dollar you pay saves you 6% in interest over the remaining life of the loan. That is your guaranteed return on that dollar. Now, compare that to the alternative. If you took that same dollar and invested it in an S&P 500 index fund, what would it return? Historically, the S&P 500 has returned approximately 10% annually before inflation and approximately 7% annually after inflation adjustment over the past century. 7% versus 6%. This is the core of the argument. If your mortgage rate is lower than the expected return on your investments, you are mathematically better off investing the extra money than paying down the mortgage. At a 6% mortgage rate versus a 7% investment return, the difference seems small. But over 20 years, compounding turns small differences into enormous ones.
The compounding difference. Real numbers. Let me make this concrete with an example, because the abstract argument only takes you so far. Assume you have a $300,000 mortgage at a 5% interest rate with 20 years remaining. You have an extra $500 per month available, and you are deciding what to do with it. Option 1. You put that $500 per month toward extra mortgage payments. You will pay off the mortgage approximately 6 years early and save approximately $48,000 in interest. That is real money and a genuinely good outcome. Option 2. You invest that $500 per month into an index fund, averaging 7% annual return over 20 years. At the end of 20 years, that investment account has grown to approximately $260,000. $260,000 in investments versus $48,000 in interest saved. The investment path produces 5 times the financial outcome. This is not a trick. It is straightforward math, and it holds across a wide range of assumptions. The investment path wins, often substantially, when the investment return exceeds the mortgage interest rate.
The tax dimension nobody mentions.
Here is another layer that most people completely ignore when they run this calculation: taxes. Mortgage interest is tax deductible for most homeowners who itemize their deductions. This means the effective cost of your mortgage debt is not your stated interest rate. It is your stated rate minus your tax benefit. If you are in the 22% federal tax bracket and you pay 6% mortgage interest and you are able to deduct that interest, your effective after-tax cost of the mortgage is approximately 4.7%, not 6%, 4.7. Meanwhile, if you invest in a tax-advantaged retirement account, a Roth IRA or a traditional 401k, your investment returns are growing either tax-free or tax-deferred, which significantly increases the effective return compared to a taxable account. So the actual comparison for many homeowners is not 6% mortgage cost versus 7% investment return. It is closer to 4.7% effective mortgage cost versus 6 to 7% effective investment return inside a tax-advantaged account. The gap widens further in favor of investing.
The liquidity problem. This is the big one. Here is the argument for investing over paying down the mortgage that I consider the most compelling: liquidity. When you make extra mortgage payments, you are converting liquid cash into home equity. Home equity is an illiquid asset. You cannot spend it. You cannot access it easily in an emergency. You cannot invest it once it is locked inside your home. If you lose your job and you have aggressively paid down your mortgage over the past 5 years, you might have $200,000 in additional home equity. But the bank will not let you skip payments because of that equity. You still owe the monthly payment, and if you cannot make it, the equity you built does not protect you. Meanwhile, if you had invested that same money in an accessible investment account, you would have liquid assets available during a crisis. You could cover mortgage payments for years from that fund without any risk of foreclosure. Home equity feels like savings, but it does not function like savings. In an emergency, equity is irrelevant. Cash is what matters.
When paying off early actually makes sense, I want to be clear that I am not making a blanket argument against paying off your mortgage. There are specific situations where paying off early is genuinely the right financial decision. If your mortgage interest rate is high, above 7 or 8%, the guaranteed return from paying it down begins to compete more seriously with expected investment returns. At 8% guaranteed versus a historical 7% average from the market, the guaranteed return starts to look more attractive, especially given investment volatility. If you are close to retirement and your primary goal is reducing fixed monthly expenses rather than maximizing wealth, paying off the mortgage makes sense. Entering retirement without a mortgage payment dramatically reduces the income required to maintain your lifestyle and reduces the sequence of returns risk in your portfolio. If you have already maxed out your tax-advantaged retirement accounts and your taxable investment options are less attractive, extra mortgage payments become a more reasonable use of additional cash flow. If the psychological benefit of being debt-free is significant enough to affect your financial behavior in other positive ways, if it reduces your stress enough to make you save more in other areas, then the behavioral benefit may outweigh the mathematical disadvantage.
The interest rate environment changes everything. Here's the variable that makes this conversation different in 2024 and 2025 than it was in 2020 and 2021. Millions of Americans refinanced their mortgages between 2020 and 2022 when rates were below 4% and many below 3%. For those homeowners, the argument against early payoff is overwhelming. A 2.8% mortgage against a 7% expected investment return is a nearly 4 percentage point spread in favor of investing. There is almost no scenario in which paying off a 2.8% mortgage early is optimal. But the millions of Americans who bought or refinanced since 2022 are carrying mortgages at 6, 7, or even 8%. For these homeowners, the calculation is genuinely different. At 7 or 8%, the guaranteed return from paying down the mortgage starts to compete much more closely with expected investment returns, especially given that the market can deliver negative returns in any given year. The correct answer depends on your rate, and your rate depends entirely on when you got your mortgage.
The decision framework. Let me give you a clear decision framework for this question. Step 1. What is your mortgage interest rate? This is the guaranteed return you receive for every extra dollar you pay. Write it down. Step 2, have you maxed out your 401k to capture the full employer match? If not, do this first. The employer match is a guaranteed 100% return that beats any mortgage payoff. Step 3, have you maxed out your Roth IRA if you are eligible? The tax-free growth advantage of a Roth is significant enough that it should generally come before extra mortgage payments. Step 4, now compare your remaining mortgage rate to expected investment returns. If your rate is below 5%, invest. If your rate is between 5 and 7%, it is a genuine judgment call based on your risk tolerance and liquidity needs. If your rate is above 7%, the math begins to favor paying down the mortgage. Step 5, consider your timeline. If you are more than 10 years from retirement, investing has more time to compound and the volatility risk decreases. If you are within 5 to 7 years of retirement, the certainty of mortgage payoff becomes more valuable.
The bigger picture. The mortgage payoff question is ultimately a question about what you value more, certainty or return. The mortgage payoff gives you certainty, a guaranteed rate of return equal to your interest rate. No volatility, no sequence risk, a specific date when the debt ends. The investment alternative gives you higher expected return, but expected is not guaranteed. Markets fluctuate, returns vary by decade. You could have a bad sequence of years that temporarily makes the investment path look wrong, even if it is mathematically correct over the long run. What is right for you depends on where you are in life, what you earn, what rate you are paying, and how much uncertainty you can tolerate without making behavioral mistakes. But most people making the mortgage payoff decision are not thinking about any of this. They are operating on a cultural assumption. Debt bad? Pay it off, without examining whether that assumption produces the best financial outcome in their specific situation. That examination is what this video was about. And now that you have done it, you have the framework to make the decision deliberately rather than by default.